Recovery was just off to a fantastic start at the beginning.
Yeah.
Okay, gang, it's 7 o'clock, so I'm gonna get right to it. Looks like we have 12 participants tonight, so I imagine that has a little something to do with some competing commitments some of you Chiefs fans had, so that's just fine. Tonight I want to go over Module 5. We were originally scheduled for Module 6 tonight, but I didn't have a recorded lecture of Module 5 out there. I had a recorded lecture on Module 6, so I'll just swap these two and then we'll have all the material on our YouTube page. A couple of you pointed that out, so I'm hopeful that that little change will get everybody caught up and get us back on schedule. I took a look at the exam results that have been submitted so far, and I was pleased. Scores look pretty good. That exam window doesn't close until I think tonight at 11:59. So I'm not reviewing it tonight. I'm not taking questions over it tonight. Check it tomorrow. You'll have full access to all of the questions and the author's rationale and explanation of the answers for those questions. And sometimes they even specifically tell you why what you missed was wrong if the question's a little tricky. And I have found in semesters past that that's usually does a pretty good job of answering all of the questions that come from the class. So check that. You know, I got a question from you via email I wanted to address. You were asking about that SMF add-in, and I wanted to give a little reminder to the class that that is a piece of software, a piece of freeware actually that was developed by a gentleman down in Phoenix. His name's Randy. I forget his last name now, but he developed that and it worked for a period of time. And here, just in the last really year, a lot of those links that that piece of software draws from around the internet don't seem to be working anymore. So for the purposes of this class, I think we just need to assume that will be broke and that will be broken, and we need to pull that information from Morningstar or another reputable source. So Morningstar, Reuters, some of those other databases that we looked at 3 weeks ago, Bloomberg, FactSet, so on and so forth. They all have the same data. Unfortunately, it is a little bit of work to go get it, but I think that you'll find that that can all be done inside of an hour. Most of those programs have historical financials that you can download directly into Excel. Boy, I tell you, this Zoom changed the way that they do, changed the way they operate. And now I have to admit everybody that logs into this class. If anybody knows a way around that I can just admit everybody all at once, let me know, because now everybody that is even just a little bit late, I got to admit, and I'm afraid that I'll leave somebody in the waiting room. So I apologize if that happens. So I'm recording this lecture. I'll get this posted after after we finish Module 5 tonight. The exam will be open for review tomorrow. Wanted to give everybody the heads up about the SMF add-in. I'll be lecturing on Module 5 here tonight. Before I launch into it, let me open it up for questions. How's everybody doing? What's on your mind? We can address those right at the top of the class tonight.
I have a question, Professor.
Yeah, please.
Yeah, for the research, is there any specific like number of pages that we have to be limited to?
There's examples on our site. So there's no specific number of pages, but I would encourage you to go out to our Canvas site and, let's see.
Module?
Yeah, if you click on modules and scroll down to research report, there's some, let's see, old sample reports. Here's one from Qualcomm. So look at Qualcomm, look at CBS. Those are both terrific examples. Try to structure your research report off one of those. Either one of those will get you an A. So what the grading criteria are, I want this report to be indicative of something that you would feel comfortable handing a future employer as a writing sample. So I just hired an open position for a customer service representative at our firm. I got over 200 applications, and I focused very much so on their ability to communicate with our clients. And this is an example of what I hope will come out of this class.
Perfect. Thank you.
Other questions? Okay, gang, I'm not going to lie to you. I'm a Chiefs fan, so the faster we get through Model 5, the quicker I can get back to the game. So let's do it. Revenue recognition and operating income is the topic of the day. Every one of the research project companies that you're looking and researching this semester will have their own revenue recognition policies. Some of you are doing research on service firms. Some of you are doing research on manufacturing firms. Some of you are doing research on construction firms that will have very long-lived cycles. If you're working with a shipbuilder or a nuclear power plant builder, for example, it may be 3 to 5 years before you can actually collect on contract revenue. And the accounting for each of those different types of organizations varies. And the estimates that we have to make of when that revenue is going to come in similarly varies. So we have to be familiar with those accounting policies, and you will find those in the 10K filing underneath a section called revenue recognition. So this week, your job is to find that and understand what it means for the companies that you're doing research on. How do they book revenues? And what, if any, estimates are associated?
Felipe Coutinho. Olha o toque pro Marcelo. Chegou o goleiro. Tocou. Olha o gol. Olha o gol. Olha o gol. Olha o gol. Olha o gol.
All right. Somebody needs to mute themselves, but I really like your style. So whoever that was, reminder, I'm gonna put everybody on mute, and then you can take yourself off mute if you want to ask a question, no problem. Okay, so let me get into first learning objective here. We're going to apply revenue recognition principles and assess the results. So before I get into the slides here, I want us all to think conceptually about what we're doing. When we apply revenue recognition principles, we're just like with anything else, we're using GAAP, generally accepted accounting principles, and they're just that, they're principles. They're not universal per se. They give us some practical applications, and we're gonna try to adhere to those as best we can, but for different circumstances, they're going to be a better or worse fit, as the case may be. So we need to understand the principle. We especially need to understand the application of that principle. And then we need to be able to put on our analyst thinking cap and adjust those if necessary so that we can make accurate comparisons across time and across industry. So let's jump into Pfizer here. This is the example that our authors give us, and you can see that in the last 3 years, Pfizer booked between $52 and $53 billion worth of revenues. And as we get a little bit further into their accounting, we're going to see that we have some offsets against that, maybe some discounts that we have to be mindful of, maybe some sales on credit that we have to be mindful of. And for each of those, we're going to view them through the lens of this revenue recognition principle. And it was most recently adapted by FASB on December 15th of 2017. And it generally breaks down as follows. So you have a revenue recognition principle, and the revenue is going to be recognized when the company transfers the good. So that is further defined by when the customer obtains control of the good or service. So if you just give the good to FedEx and they drive off with it, you haven't yet made the sale. FedEx has to deliver the good, and then the customer actually has to take control of the good or service, and then you can book the sale. Now, perhaps the most important bullet point on this page is that this does not necessarily, it's not necessary to receive the cash to recognize revenue. And remember, that's why we have a statement of cash flows, because the income statement is a presentation of revenues and expenses. And revenues and expenses have to adhere to certain accounting principles, one of which is right here, that we don't necessarily have to have the cash. We can book that revenue on credit. And we'll look at that. So here's sales on credit. Anytime we swipe a credit card or make a transaction with a bill of sale, we get to book that revenue. We haven't collected the cash yet, but we're going to book the revenue, and then we're going to debit an account called accounts receivable. And as you'll see as we move through module 5 here, it's going to be incumbent upon us as the analyst to have some understanding of the quality of those revenues. And you'll hear me use that term periodically throughout this class. That term quality is an indicator of, call it trueness or accuracy or quality of earnings. Because as you can see here, revenues don't always mean cash collected. So when we book a lot of revenues based on credit terms, and I use that term quality to describe them, it means how strong are those credit terms? Are our customers really going to pay us? Are those accounts receivable really collectible? Or was that credit extended to a bunch of customers who are likely to result in bad debts? And in which case we would call those low quality revenues, or ultimately low quality earnings. So be mindful of that terminology, and throughout the semester, I want you to sharpen the skill set that's associated with being able to identify high quality earnings versus low quality earnings. And certainly as we're focusing on revenue recognition policies, the strength of a accounts receivable would be a big part of that. So here's our 5-step process for revenue recognition. And I think as we move through these, you'll come to understand that these are fairly self-explanatory. In the first step, we want to identify the contract. So who are the players, what is the good, and what are the terms of the sale of the specified good or service that we're dealing with. Then we want to identify the performance obligation. What specifically has to happen? If we're selling widgets or tables or chairs or some good, that's pretty easy. We just need to sell the good, and the customer has to take ownership or take control of that good. If it's a service, it's a little bit more difficult. So like I'm in a service industry. We provide 401k services to our clients, and the contracts that we use to engage our clients may stipulate 2 or 3 or 4 meetings per year where we will sit down and review their 401k plan. If the contract stipulates 4 meetings per year, that's 4 service deliverables. So we would earn that revenue, we would recognize that revenue as that contract is fulfilled, meaning as we actually go out into the field, meet with our clients and do those service reviews and deliver on that contract. Thirdly, we'll need a transaction price, pretty self-explanatory. The fourth rule in the revenue recognition series is to allocate the transaction price. Now, this may or may not be necessary. In the example that I just used, where we're contracting for a service deliverable and we have 4 meetings per year, well, yes, we're going to have to allocate that contract price around those 4 meetings per year. Now, the authors give us an example of contracts with more than one performance obligation. So we may have committed to do 2 or 3 things inside of the same contract. If that's the case, then we need to be able to specifically account for the fair value associated with each of those service deliverables, or the fair value associated with each good in that transaction. And as we do so, we can book the revenue associated with each. And then lastly, we're going to recognize the revenue when the performance obligation is satisfied. And there again, that's going to be defined by the terms of the contract that we initially entered into. So you can see Pfizer here, and this is what I want you to go find. I want you to go find this for your research company, research project. And you're going to see a disclosure. And in Pfizer's, what you would really take notice of is this, our gross product revenues are subject to a variety of deductions, which generally are estimated. Anytime you see that word estimated, I want your antenna to go up, because that means that somebody inside of your organization is making an estimate, and those estimates are subject to human error and or human manipulation. So we're going to play this game all semester long, this game of find the penny. If you're the CEO, you're the CFO, and you need to goose your earnings per share by a penny to hit your estimates and lock in those bonuses for the year, you're going to go looking for that penny everywhere inside a gap where it's possible to make an estimate and affect those earnings. So here Pfizer's telling us that their gross revenues are affected by a variety of deductions which result from estimates and recorded in the same period. So let me admit Brian here. So those revenues are recognized. Such variable consideration represents chargebacks, rebates, sales allowances, and sales returns. So if your company was Pfizer, if you were doing research on Pfizer, now all of a sudden you know that the revenues that they record on their income statement are subject to various estimates around these chargebacks, rebates, sales allowances, and sales returns, and you'd have further digging to do. Now you got to dig a little deeper in the back of the 10K report and go find out how they specifically account for things like sales allowances and sales returns and rebates and so on and so forth. That's what the analyst does. And as you gain a better understanding of that, you're going to be the one that's best positioned to understand the quality of those revenues. And when I say quality of those revenues, I'm basically just saying, are they real or not? Can you count on them? Or have they been manipulated by some of these estimates? Not an easy job, but if you can do it and you can do it well, you will get paid very well to do it. So on slide number 9 here, our authors give us some other complications of revenue recognition. And this is just a litany of things that you have to be aware of. So just like Pfizer disclosed sales returns and allowances and chargebacks and rebates, another company might have disclosed non-refundable upfront fees or bill and hold relationships, consignment sales, licenses, franchises, variable consideration. All of these can have effects on your revenue recognition policy. Look for them in the fine print of the 10K filing. Understand what they are, understand how they affect your company's revenue recognition policy, and then if necessary, audit them for the last few years and come to some conclusion about how well your management team has been accounting for these. Because with each of these, your company will be required to disclose how they have accounted for them in the past. And we're going to look at this here in a moment. We're going to look at a few examples of this, but what we like to see are pretty consistent, recurring, repeatable estimates for sales returns and allowances, for example, or accounts receivable, or if these items have a consistency about them year in and year out, well, then we're going to know that sales returns has a tendency to be approximately 0.5% of total sales. And if it's 0.5% of total sales for the last 5 years, and then all of a sudden you see management team lower that estimate to 0.25% of sales, well, that ought to raise a little pink flag in your mind. You know, what makes management think that they're going to have fewer sales returns this year? Now, if they have a good reason for it, fine. But if nothing has changed, then they're goosing their earnings. They're trying to inflate their earnings with a lower forecast for sales returns and allowances. And I'll show you how that flows through to the income statement. More complications of revenue, multiple contracts, rights of returns, gift cards, so on and so forth. Okay, now I want to look at this revenue recognition policy called cost-to-cost method. And the cost-to-cost method recognizes revenue as a proportion of total costs incurred to fulfill the contract. I mentioned at the top of the lecture that different companies have different types of revenue recognition policies. And for large construction firms, one, say a Jacobs Engineering or a Fluor Construction or something like that, many of their contracts may be longer than a year. So if you've worked on a construction project, maybe this is an energy plant or a natural gas facility or a nuclear power plant, it may take 3 or 4 years to build this. So if you're a year in and you have 1/3 of the cost deployed in terms of raw materials and work in progress and so on and so forth, how are you supposed to account for that? Well, FASB tells us that we can use the cost-to-cost method, and that allows a company like Jacobs Engineering to book the revenues in proportion to the amount of costs they've deployed on the project. Well, I'm hopeful that as you're listening to this, you're taking a mental inventory of all the ways that system might be manipulated. Because how do you know if you're 15% to completion, 20% to completion, or 25% of the way to completion based on your costs? Well, that's a big estimate, right? And the only people that are in a position to actually estimate that are the company's management team. So this leaves a lot to their discretion. And this is a huge opportunity for earnings manipulation. And I just want you to be mindful of that. I'm not accusing anybody of earnings manipulation, but I'm saying that if we're going to account for this, we have to come up with a way to account for it in some annual basis. It's not easy. FASB gives us some guidelines. They're the best we have, but it does introduce the opportunity for earnings manipulation, and we have to be aware of that as an analyst. So the next few slides here, our authors go through an example of this cost-to-cost method. I'm not going to go into this in class because it's generally pretty self-explanatory. If you've incurred 40% of the cost, then you book 40% of the total revenues. Okay. Learning objective number 2, we want to examine and evaluate sales allowances. So high level here, let's think conceptually about what we're doing. We're accounting for returns. Let's just take, I don't know, let's take like Apple. You go to the Apple store, you buy a pair of headphones. I just bought a pair of their new Powerbeats Pro. They're awesome. I love them. I wear them when I run. The best headphones I've ever worn in my life. But for a while there, the left one wasn't producing any sound. I thought I was going to have to take it back. I troubleshooted it and figured out how to make it work. But for the sake of this example, let's say I would have had to have taken it back. Well, Apple either would have given me a new set of headphones or they would have given me my cash back. If they had given me my cash back, that would have been accounted for as a sales return. On a quarterly basis, on an annual basis, Apple knows that a certain percentage of their product is going to be returned. And FASB says that they need to account for that. If you If you sell $1 million worth of goods and you know that a percentage of those are going to be returned, well, then on your income statement, you need to report the net number, meaning net of returns and allowances, which requires the management team to make an estimate of what they think is going to be returned. And that's pretty easy for a company like Apple because they've been doing this a long time and they have good data on what they would expect to be returned. But for another company, that might be a little bit more challenging. Okay, let's take a look. So it's not just sales returns, but you also have sales discounts for volume purchases. We need to be able to estimate those and account for those. And then we have retailer promotions. So I mentioned that FASB requires the net number to be reported, and we're going to look at how they get at that right here. So here's an example in micro. Let's assume the following for Levi Strauss. Levi sells a pair of jeans for $130 on account. And on account means that they don't take cash, they take accounts receivable. So the jeans cost $80 and they expect returns of 3% of sales. So if they sell 100 pairs of jeans, 3 of them are coming back to them. That would be their expectation. So based on that, we can debit allowance for sales returns of $3.90. That's 3% times 130. So we're going to book that as a debit, and that's going to offset the revenues that we book for the jeans. And you can see here, we're going to make a similar accounting entry for the adjusted cost of goods sold. We know the jeans cost $80. So when the 3 pairs of jeans, 3 out of 100 come back, we're going to have a proportional credit to our inventory account of $240, debit to our inventory account, excuse me, and a credit to our cost of goods sold for $2.40. So we're basically reversing 3% of the jeans sales that we just made through our income statement. And you can see the net effect of that presented on the income statement down below, where we have sales, $130 worth of gross sales, less $3.90 of sales returns and allowances. That reports the net number as $126.10. Then we've basically done the same thing for cost of goods sold. Cost of goods sold gross was $80. $2.40 were returned, which was a credit to cost of goods sold, and the net of those two numbers was $77.60 for a gross profit of $48.50. So that's the accounting, and you need to be familiar with the accounting, but the main point of the slide here and the main point of module number 5 is the revenue recognition and the estimates that are associated with that. And in particular here, the driving estimate is that we expect 3% of sales to come back to us. Now, how do we get that number? Well, for a company like Levi's, 3% of sales is probably their historic return rate. Now, what if in a given year, they make just a bad batch of jeans? Something's wrong with the stitching, or they got bad fabric, or the style goes, or the jeans go out of style. Well, that might be 5%, 6%, 7%, who knows? It's an estimate, and as estimates, again, can be manipulated. Now, with the disclosures at the back of the 10K filing, you're going to see something similar to this table. And it's your job as the analyst to be familiar with this table. And it's going to reconcile some of these estimates over the last couple of years. And you can see how these numbers flow through in aggregate. You're going to see sales returns and allowances at the beginning of the period, any additions that were made during the year, any reductions, and then the ending balance. And you can see how those numbers flow through for several years in a row. And you should be able to use these numbers along with some simple math to determine how well management's doing in estimating their own returns and allowances. And the second table down here gave you a little information on discounts. Okay, there's different ways to analyze sales allowances. The simplest and easiest that I like is as a percentage of gross sales. That's the 3% number that we were just looking at. Another measure is adequacy, and you can see on the next slide here that adequacy is given to us in this third table. But first, let's walk through number 1 and number 2. Number 1 presents the additions charged divided by gross sales. So what amount of additional charges, which is right here, 603,594 in 2018, divided by gross sales, 6.179, and you can see how that trends over time. In 16, it was 10.3%. In 17, it was 10.1%. And then in 2018, it was 9.8%. Okay, let's take a look at another measure, which is the allowances account as a percentage of gross sales. That's trended from 2.8 to 3.3 to 2.8. And then lastly is the adequacy, where we take the estimated amount, which would be the additions charged, that is this number up here. We take those estimated amounts and we subtract from them the actual amounts, which was the 611,742. And we can see here that our estimates were 98% of the actuals in 2018. In 2017, they were 107. In 2016, they were 104. So in 16 and 17, we were conservative in our estimates. In 18, we were a little more aggressive in our estimates. So what's that mean? Well, our authors tell us here that because the sales allowances require estimates, managers can pad or shave their estimates to help the company meet net sales or earnings. Is that what Levi was doing? Were they conservative in the first 2 years and then less conservative in 2018 because they were trying to pad their earnings? Maybe. What the authors recommend when you see something like that is that you go through and you adjust the numbers to undo any potential deliberate or accidental variation in the years. And here's how you would do that on the next slide. You would do that by looking at the average rate over that 3-year period, which just so happens to be about 10%. And then you can adjust the financials by taking that 10% number and applying it retroactively to all 3 years. So if the additions charged as a percentage of gross sales were 10.04% in every year, then you can recompute gross sales, additions, adjustments, and net sales in that scenario. And then this is the number that you would use as maybe call it an unbiased number or an adjusted number if you were trying to compare these across time and across industry. And when you do this for sales returns and allowances and revenue recognition policies and inventory policies and every little piece of accounting that we're going to be looking at throughout the semester, these have a tendency to really add up over time. And usually the way this works on Wall Street, or if you're working for a mutual fund company and you've been tasked with monitoring, when I worked for the Buffalo Funds, I had 50 companies that I monitored, and that was my full-time job. So I had income statements and balance sheets and statement of cash flows that I had laid out in an Excel file that represented how I saw the most accurate economic representation of the company. And all these adjustments were made. And it took an incredible amount of time to do that. And I couldn't have done it unless I was working full time as an analyst. So when you go through this, it's going to seem painstaking to make all these adjustments. Don't get discouraged. When you start to pull together your research project, you're going to go back and you're going to be looking at each one of these modules, and you'll see how the research projects lay those out in an appendix at the end of those reports. Most of the time, you're going to look at something like this, and you're going to come to the assessment that this is not materially meaningful to the decision that you're trying to make with regard to whether or not you want to buy or sell the stock, or material with regard to determining the share price that it's worth, material to its underlying fundamental fair value. And you're just going to be able to notate that in the report. Sometimes it's going to be material. And when it is, I expect you to be able to go into great detail to explain it and make the adjustments. But in cases where it's not, it's sufficient just to understand the material at the level of the homework assignment and at the level of the exam, and you won't be called upon to draw that into your research report. Okay, so when we adjust those numbers, we're not only going to restate the income statement, but anytime we restate the income statement, that's going to flow through to the balance sheet and have effects on our ratios. So that's basically the point slide number 25 is making here. Okay, let's move on to deferred revenue. We're still underneath the broad heading of revenue recognition policies, but deferred revenue has not yet been earned. So up here at the top, our authors say deferred revenue, unearned revenue, those two things are the same thing. And maybe I'm just dense or thick-headed, but I swear it took me 20 years to figure out deferred revenue and unearned revenue were the same thing, because you read different accounting textbooks and you read different authors, and they'll use one or they'll use the other. And it was just confusing. So my hope is that by pausing there and just starring that, you won't run into those same issues, and you can just always recognize that deferred revenue and unearned revenue are the same thing. This typically results from a situation where we have promised to deliver a good or a service, but we haven't yet fulfilled on that obligation, but we've already been paid for it. So if we've been paid, now we have an obligation. We have a liability to deliver that service. We have a liability to deliver that good, which is why unearned revenue or deferred revenue is not revenue at all. Unearned revenue or deferred revenue is actually a liability. So you might just circle that right there. It's a liability. It doesn't show up in the liability section of the balance sheet. It shows up in the asset section of the balance sheet, but it shows up as a contra revenue, which it means it's going to be deducted from gross revenues. Okay, let's look at unearned revenue here. So on this slide, number 28, our authors are giving us the reconciliation table. So just like we had for sales returns and allowances, we're going to have a reconciliation table for unearned revenue that gives us some insights into what's going on from year to year to year. And in this instance, we have Lowe's Corp. We can see that their deferred revenue in 16 was 729 million, 803 million in 2018. And then they added to that in 16, 17, and 18. And then they recognized some of that deferred revenue. And in each year, then we had an ending balance. So this gives us what we need to do an analysis of this deferred revenue. And we're going to do, well, I guess our authors don't even go into it. But what we can do is we can compute the percentage of total revenue that was deferred. So if we have a portion of our total revenue that's deferred every year, well, we'd like to see that stable from year to year to year, just like we'd like to see sales returns and allowances stable from year to year to year. That's usually a pretty good indication that there's no gamesmanship going on with the underlying accounting. So take a look at that And if anything jumps out at you, that'll be the little pink flag that you need to go do some more digging. Okay, learning objective number 4, evaluate how foreign currency exchange rates affect revenue. So we're moving on from revenue recognition policies, but we're moving into another aspect of accounting that can have a big effect on our revenues. And that is foreign currency translation adjustments. So let's take Apple as our example again. They sell phones and services and music and headphones and all kinds of good stuff around the globe. When they're selling in Europe, they're obviously collecting in euros. When they're selling in China, they're collecting in yuan. When they're selling in Japan, they're collecting currency in yen. And all that currency has to be translated back into US dollars, because when you look at their 10K filing, all of those numbers are reported in US dollars. So we, as the analyst, have to know that as the US dollar weakens versus other currencies around the world, the US dollar is going to buy fewer of those foreign currency units. So when the income statement of a foreign subsidiary is translated into US dollars, the income statement grows. That's when the dollar weakens. So when the dollar weakens and we have a bunch of euros that we have to translate back into dollars, we're going to get more dollars for those euros. So the balance sheet also grows, resulting in higher US value assets. Okay, one thing I wanted to say on this slide here. Just put a star beside these 4. Those would represent good test questions. Find your foreign currency effects paragraph in your 10K filing so that you can know to what degree your company might be doing business internationally and to what degree your company might be influenced by changes in the dollar, strengthening of the dollar, or weakening of the dollar. That can have a big impact on your financials. And you should expect to get guidance from your company management teams with regard to how they see the dollar fluctuating in the future, or maybe what they're doing to hedge out that foreign currency impact from their financials going forward. You also should expect to see guidance on whether or not they're repatriating some of that cash, which will have effects on your taxable situation. So be mindful of all of that. Okay, so our authors give us 3 examples of how a strengthening or weakening US dollar might affect our financial statements. The first one is a US company transacts business in foreign currencies. So this was the example I just gave of Apple selling iPhones in Europe, collecting in euros, and then having to translate those into US dollars. As the dollar weakens, that benefits those sales that were made in the euro. Another example might be a US company borrows in a foreign currency. So we're going to translate those debts back into US dollars. Now, if it's sales and the dollar weakens and we translate that back, that's great. But if it's not sales, if it's borrowing, meaning if we have borrowed in euros and the dollar weakens, well, now it takes more dollars to pay that back. And that's going to result in a foreign currency loss on our income statement. And then lastly, number 3 here, the authors give us the example of a foreign subsidiary's cash that is repatriated. And you see that periodically as companies earn dollars, euros, yens overseas. They'll want to repatriate those and convert those back into dollars. So there's more to this topic, but we won't cover it until module 9, I think it is, when we'll talk more about how we calculate those foreign currency gains and losses. The Tax Cut and Jobs Act of, I think this was 15, removed one of the major barriers to repatriating those dollars from overseas. Before the Tax Cut and Jobs Act, we were seeing huge billions and billions and billions of euros, of yen, of foreign currency accumulate on the balance sheets of multinational companies because there was a much higher tax to repatriate those. It used to be 35% to bring those earnings back to the United States, and they lowered that to 15.5. So you've seen much of that currency come home in the last 3 years. And on account, if you look back historically, you might see some financial statements that are a little bit distorted. All of those fund flows, well, they had a big effect. And if that's driven by legislation that was passed in 15, then we need to know that there's nothing fundamental about the business that changed. That's just a management team taking advantage of some legislation that was put in place to encourage those dollars coming home. So if you're looking at a multinational conglomerate, just keep that in mind. It might explain some big cash flows. Okay, I don't need to spend any time on that slide. Learning objective number 5, analyze accounts receivable and uncollectible accounts. So this is very similar to what we were just looking at a few minutes ago to sales returns and allowances. Just like we wanted to report sales as gross sales less sales returns and allowances equals net sales, we want to report accounts receivable as gross accounts receivable less allowance for bad debts equals net accounts receivable. Because if we have $1 million in accounts receivable, well, we know there's going to be some deadbeat like Vern Cushenberry that's not going to pay you back. And he's just going to default on his debts. I'll use myself as an example for lack of another deadbeat in class. So that happens. We know it happens, and FASB tells us that as good accountants, we have to reserve for that. And that's going to present a more accurate representation of our financials. So we have to make estimates. We don't know what exact percentage of those accounts receivable are going to be bad. So we got to estimate it. Ding, 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 ding. That should put up a little pink flag again. Whenever you hear that word estimate, you know that it introduces the likelihood for some shenanigans. And sure enough, when we look at, I don't know if this is Levi Strauss we're looking at here again, but it doesn't matter. We're looking at company financials here. And you can see at the bottom, we have an estimated percent of uncollectible. Well, that might be 2%, it might be 3%, it might be 4%. In this particular example, the company has used an aging of accounts receivable schedule. So they should know from past experience that $50,000 in sales that were made in the current period will yield approximately 2% uncollectible. Now we have $30,000 worth of sales that are 1 to 60 days past due. We know from experience that approximately 3% of those are uncollectible. We have $15,000 worth of sales that are 61 to 90 days past due. We know from experience that approximately 4% of those are uncollectible. And then we have $5,000 worth of sales that are 90 days past due or greater. And we know from experience that approximately 8% of those are uncollectible. Well, that's simple math, multiply across, add the columns down, and that produces an estimate of what would be allowance for doubtful accounts of 2,900. And we would present that as an offset to accounts receivable. The main point there being not the math or how we get there, but again, these numbers are estimates. Now, the aging of accounts receivable schedule should allow us to zero in on a more accurate estimate, but that doesn't mean that we've taken precautions that are going to eliminate any human error, and it doesn't mean we've taken precautions that are going to eliminate any misrepresentations for sure. So you will see a similar account in your 10K. Look it up, see how management has historically estimated that allowance for bad debt accounts, and see if you can identify any shenanigans there. Okay, I kind of skipped through the accounting there. I'll let you look at the transactions on your own. Booking an allowance for doubtful accounts is pretty easy. You make the estimate and then you book the account, and that's a direct offset to accounts receivable. And then importantly, when an account actually does go bad, you're going to write off the specific accounts receivable, and then the offset will be your allowance for uncollectible accounts. A couple other ratios that I'll mention here in, well, just like sales returns and allowances, if we look at this in ratio form, that gives us the opportunity to look at the series across time and across industry and draw insights as usual. And two of those that are more common are sales divided by average accounts receivable, and then another one that we call days sales outstanding, which is the days in a year, 365, divided by accounts receivable turnover. And you can see examples down here for Pfizer. We would want to take this 6.6 number and look at that for 2018, 2017, 16, 15, see how it had trended over time. And if it's right there around, 5, 6, 6.5, 5.5, that's pretty consistent. And consistency is a good thing for an analyst. It gives us confidence that nothing has historically changed. But if we see that number bouncing around with a little bit more volatility to it, that's our signal that we need to go do some digging. Okay, when you look at those ratios, there's a couple of different ways to interpret those. When we see the days sales outstanding lengthening a little bit, or lowering the accounts receivable turnover ratio, or a higher percentage of accounts receivable to sales, that might indicate an unfavorable trend, which is explained either by more leniency in granting credit to its customers, or worst case scenario, the credit quality is deteriorating. And those two can go hand in hand. And you often see that by retailers who are anxious to make their quarter end sales. Well, if you just loosen up your credit terms a little bit, you'll make more sales. Problem is, in the process, your quality of earnings is declining. So I mentioned that a moment ago. Here's Pfizer's accounts receivable turnover across the last 5 or 6 years. Generally pretty consistent. Their average days sales outstanding is lower than it was 4 years ago. So the credit quality of Pfizer's customers is getting better. They're paying faster. Their accounts receivable turnover is higher. Those are all strengthened numbers. That's a good thing. That's a healthy indicator of their accounts receivable. And I would be inclined to give that the thumbs up. That's something very positive that you're observing there about their accounts receivable in Pfizer's numbers. Okay, that's the same data. Okay, just like we did for sales returns and allowances, if we do see an abnormal variance in those numbers, it's our job as the analyst to go back and make the necessary adjustments. So we can calculate what the average rate was for the last few years. And if we look at Pfizer again in this example, we can see that the average allowance as a percentage of gross sales has been approximately 6.6% over the last few years. And then we can apply that retroactively as if it had been 6.6% in every year. So we come down here and we know that it was 6.89, 6.63, and 6.32 in each of 16, 17, and 18. And now we're going to adjust those numbers as if it were 6.17. And based on those adjustments, we get these numbers down here. And we have, I think on the next slide, a restated bad debt expense. We'll have a restated income tax associated with that because it'll flow through the income statement. And then we'll have a restated net income number. And in this instance, we can see that net income went up by 19.2, 1.6, and down by 20. So if, as far as you're concerned, when you're doing your research report, eyeball it, make some determination with regard to materiality. If it's not material, meaning plus or minus 1 or 2%, if it's inside of that zone, then you can just simply state that no material adjustments were necessary. If it is material, if it's going to make a difference, then you need to go through this exact process and you need to restate the numbers so that I know you have a good understanding of what's necessary when you're functioning as an analyst. Okay, let's move on to learning objective number 6. Analyze operating expenses and discontinued operations. So this is kind of a kitchen sink category. We've gone through all the revenues. We did cost of goods sold, and now we're looking at other operating expenses. So these are just the sampling of a lot of other expense categories that many of the companies that you're analyzing this semester will have on their income statement. And I'll just hit on some of the highlights here. Every one of these should have disclosures in the back of the 10K filing that give you more information about how the company assigns different expense categories to these broad headings. These are usually large roll-up items for most major Fortune 500 companies, such as cost of sales, SG&A, research and development, amortization of intangibles. You've all had accounting as a prereq, so these should be very, very familiar. And what goes into these will be disclosed by each company separately. But for something like SG&A, you're going to see salaries, marketing, IT, legal, so on and so forth. Then you'll see restructuring charges, taxes, discontinued operations, income attributable to non-controlling interest. We talked about that one earlier in the semester. R&D costs. I always like to stop on R&D costs because early in my career, I was interviewing for a job in New York for AllianceBernstein. And I ended up getting the job, but not before I embarrassed myself pretty good. When one of my interviewers, I had 4, asked me specifically how you account for research and development expenditures. Or maybe she just asked me how you account for research and development. And I couldn't remember exactly how you did it. So I said that you capitalized it. Don't ever say that. You'll embarrass yourself. It's wrong. There's a dead giveaway in the name of R&D expense. It's an expense. You immediately deduct it against revenues on your income statement. Is that accurate? That's a different question. She didn't ask me that question. Is that accurate? It creates a whole new conversation that accountants have been having for a long time about the nature of R&D expense. Because if you're a technology firm or if you're a pharmaceutical manufacturer, research and development expense is much like a capital expense. It's part of the ongoing needs of your business to develop your pipeline. So we as analysts can think of it that way. If we want to account for it as a capital expense, it's not GAAP. It would be a retroactive adjustment to our financial statements. But if we were comparing across time and across industry, it would absolutely give us some insights into how well your company versus its competitors were developing its pipelines. And I can show you some data in support of that here in just a minute. But remember that R&D costs are almost always expensed. And when we look at R&D costs, we can see that they vary by industry widely. Here's a little chart that shows our R&D cost as a percentage of revenue. But for pharmacy and tech, you know, we need to see R&D costs that are up here in the mid-teens to high teens. And if you're, you know, if you're not up there in the mid to high teens, then there's a pretty good chance that 3, 4, or 5 years from now, you're going to get competed out of business, because pharmaceuticals, especially, they have to continually reinvest in new drugs. And if they run out of a pipeline of new drugs, well, that's their whole business model. If they don't have any new drugs to sell, they're going to go out of business. So if you don't see R&D expense up here around 14%, count on that resulting in lower sales 4 or 5 years from now. So if you are doing business on a pharmaceutical company, pay very close attention to R&D costs and how they've varied over time. And if you start to see a dip in R&D costs, what might that indicate? It might indicate a management team that's trying to shave a few dollars off of an expense line item today so that they can report higher earnings today at the expense of long-term earnings growth tomorrow. And that, it might be a good thing today, but it's generally a pretty negative thing for long-term shareholder growth. Now, here's a great table that looks at R&D cost as a percentage of revenues, not just across time, but across industry. So in this one, we can see Pfizer versus AbbVie, J&J, Merck, Novartis, so on and so forth. Pfizer's at the low end, 14.9. There's a couple that are lower, but look at Eli Lilly up here. Eli Lilly is a good 10 percentage points ahead of the rest of the industry. Now, if they're successful, if they can bring some of these drugs to market, that's going to be a great thing for their long-term futures. Okay, taxes. I don't need to mention, I talked about the Jobs and Tax Act already, so I don't need to talk about that again. I do want to remind everybody in class that you will see a table on taxes in the back of the 10K filing, and it's your job to go look it up, and there'll be a reconciliation between taxes paid and the effective tax rate. Now, that's just a little preview of a deeper dive that we'll take later on in the semester when we get to, I think it's module 8 or 9. So just know that's coming. Discontinued operations, I want to make a couple of points on this slide, and 2 of them are right here. Discontinued operations are just that. They have been discontinued, which is one of the reasons why we report them separately. We report them separately because analysts and generally most users of the financial statements have an interest in the core operations of the firm, meaning what are the operations of the firm that are likely to persist in the future? Tell me what this firm is going to look like next year and the year after that and the year after that, so that I can get a handle on the earnings power. Discontinuations are not a part of that. They've been discontinued. They're going to be scuttled. They're not a part of a company's future, which is one of the reasons why we take those and we put them off on the income statement in a separate little category called discontinued operations, so that you as the analyst can now make that decision for yourself, whether or not those are going to be relevant to your task at hand. And when we report those, we not only report them separately, but we report them net of tax effect. And you can see down at the bottom here, we have discontinued operations divided between the income from those discontinued operations, net of tax, and the gain or loss on the disposal of the discontinued operations, again, net of tax. Okay, why segregate? I just hit all those points, so I'm going to move on. Okay, interpret pro forma and non-GAAP disclosures. This is a quick one, but a very important one. And what our authors are talking about here are pro forma non-GAAP disclosures are encompassing of a wide variety of data that management teams will share with the public that has nothing to do with GAAP. Generally accepted accounting principles, those GAAP numbers, they're regulated. They have to be calculated according to certain principles by law. Non-GAAP numbers are not regulated, and management team can present them in any way, shape, or form, any format that they want. Sometimes they're very, very meaningful. Sometimes they're key performance indicators that we want to be mindful of. Always we want to be mindful of them, but we don't want to ignore the fact that they're unregulated numbers that are easily manipulated by unscrupulous management teams. So there's a certain, what our authors call a certain level of opportunism associated with those, and we need to be mindful of that. So just know that whenever you're dealing with non-GAAP numbers or KPIs, that they're unregulated. And then our authors give us both an example of how Pfizer reports those, and they also give us an example here on slide number 62 of a specific warning that the SEC gives investors when they're using non-GAAP numbers provided by their management teams. So I love this slide number 63 because it's a great summary of our whole class. It's a great summary of this 16-week period that we're spending together trying to figure out how to analyze financial statements and how to create valuation from those financial statements. And to do so, we want to look at a few key things. We want to look at what the auditor has told us when they have audited the financials. We want to look at any deviation from the boilerplate language. We want to understand the accounting policy footnotes. We want to compare those to peer groups. We want to understand and examine any changes in accounting policies. We want to compare key ratios over time. We want to review the ratios of competition and consider how macroeconomic conditions have shifted those ratios over time. We want to identify any non-recurring items and separately assess their impact on company performance and position. And then lastly, we want to recast those financial statements as necessary to reflect the accounting and policy more in line with the true underlying economic reality and the competitive environment. And then what we'll get to in the last 3 weeks of the semester is that after we've recast those financial statements, we want to forecast them and use certain valuation techniques to help us determine what the company is truly worth on a per share basis. But for the first 10 weeks, this is a great little formula of the whole book and the whole class. Okay, gang, that's module 5. I was moving pretty quickly, but I think I covered most of the high points there. So I'm going to pause for questions. What do you got?
I have a quick question about the homework.
Yeah.
So I looked at number 2 of the module 5 homework, and I thought the answer was just taking 98% of the gross sales to get the net sales, since there was a 2% return that was expected. But when I put that in, it was wrong. And then when I checked through the answer key available, it was the same thing I did. So I don't know if it's like a system error or I don't know.
It might be, Fiona. Those questions are what they call algorithmic. So they take those numbers, and what you're seeing will be different from what everybody else in class is seeing.
Mm-hmm.
So send me a screenshot of it and I'll investigate and get back to you. And if I find out that it's something that's global in nature, meaning that it's affected everybody in class, I'll just shoot out a blast and make sure everybody gets the points. Does that sound fair?
Thank you.
Yep.
Mhm.
Hey, I got one question.
Yeah, far away.
I'm a little embarrassed to admit, but I haven't taken the test yet.
No.
If I wanted to take it at 11:50, do I still have 2 hours to take it?
Yeah, I think it closes at midnight.
Okay, great. That's all I had.
Right on.
Have a great day. Gotta
Yeah.
watch this Chiefs game.
Procrastinators unite.
Well, yeah, we'll get through it.
I'll get through it.
Yep. Bye-bye.
Bye. That was my favorite question. All right, gang. Anything else? Okay, well, I'm going to post this lecture to our YouTube site. It'll be out there. There's already one on Module 6. So thank you for bearing with me. I thank you in advance for your patience. Next week, we'll just rely on that recorded YouTube lecture. Look for the test results to post after that closes tonight. Get in touch with me if you have any questions. Fiona, you're going to send me a screenshot, and I'm going to track that down for you. And then aside from that, I think we're on pace, having a good semester. So thanks, gang. Have a great night.